Okay, hello everybody. My name is Scott Fuller, founder of leavingthebayarea.com and leavingsocal.com, and we've got another great information session for you today. I'm really excited to have our guest today, Teresa Fluegel, with Executive Vice President, and Mary Cunningham, President and CEO of Chicago Deferred Exchange Company. And we are going to be talking all about 1031 exchanges. So if you've ever had any questions about how it works, who it's for, anything like that, we're going to go through all of this great information, and I appreciate you taking the time to join us. So Teresa and Mary, welcome.
Thank you.
Thank you. Good afternoon, everybody. Thank you for having us here today, Scott Fuller, to talk about 1031 tax deferred exchanges.
Fantastic. So why don't we start off, give us kind of your background. We'd love to hear more about your background, your introduction, and stuff like that.
Sure. So Chicago Deferred Exchange Company, we have been in the 1031 industry for 30 years. And a little bit about myself. I am out here local in the Greater Bay Area in California and been specializing in 1031 exchanges for 20 years. So we hold clients' hands, walk them through the process, answer questions, make them feel comfortable with the transaction that they're going to be doing for their 1031 exchange.
Hi, I'm Mary Cunningham. I am President and CEO of Chicago Deferred Exchange. I've been with the company for 30 years. I started when I was 10. I'm based in Chicago, and we do provide services for investors all across the country. So we have a national business, and Teresa and I have had a really nice time working together, and happy to be here.
Fantastic. Well, again, appreciate you both taking the time to join us today. For those of us who are watching, if you have any questions, there's a Q&A box where you can enter in any questions that you have, and we'll address those as they come in, or if we're going to be addressing those in the next slide or two, we'll let you know. But we want to make sure that we're getting all of your questions answered, and I think that we're going to do a pretty good job of that today. So, Teresa, why don't we start off with, give us a background on what exactly is a 1031 exchange?
Sure. Mary, do you want to start?
Sure, I'll dive into that one. Sure. Well, 1031 is a section of the Internal Revenue Code that allows an investor in real property to exchange that property for other like-kind real property within a short window of time, 180 days. And in doing that exchange, you can defer recognizing gain on the sale of your old property. So it's a tax deferral mechanism that's used by investors all shapes and sizes all across the country. The screen says 1031A. The code itself is very short, but it was modified recently when the Tax Cuts and Jobs Act was signed into law in December of 2017. So prior to the TCJA being signed, 1031 applied not just to the exchange of real property, but to other types of personal property, including capital assets, intangible properties, certain types of collectibles. But the TCJA limited the application of 1031 to apply only to real property that's held for investment or for use in a trade or business. So again, it's a great tax deferral tool for all different types of investment real property.
Yep. And we'll get into some of the mechanics and the qualifying property as we go along through the slides. So our role as the qualified intermediary, we are a qualified intermediary that is an unrelated third party who is not the taxpayer or the disqualified person who acts to basically facilitate the deferred exchange on behalf of the taxpayer under Internal Revenue Code Section 1031. So in order for you to be able to defer the tax, you have to do a 1031 exchange and use a qualified intermediary. And we also do need to be involved prior to the close of escrow on your sale property so that we can prepare documents and receive your funds at the close of escrow. So we definitely want to make sure that our clients don't have any constructive receipt of funds. If they receive the funds at the close of escrow, it's going to be too late to do a 1031 exchange. So failure to comply with the safe harbor requirement that the QI acquires and transfers the property results in a disqualification of an exchange. So usually clients will hear about a 1031 exchange from either maybe their broker, their real estate attorney, their tax attorney, their CPA, and then we get involved prior to the close. So we are one of the nation's oldest and largest qualified intermediaries in the country. We've been in business for 30 years. We're headquartered in Chicago, and we do exchanges nationally, as Mary mentioned. We have offices in New York and San Diego here in the Bay Area, and then we're headquartered in Chicago. And we are a subsidiary of Wintrust Financial Corporation, which is a $42 billion financial services company. So we're a bank-owned qualified intermediary. We do two things. We either do a forward exchange when clients are going to be selling and purchasing property, or we act as an exchange accommodation title holder when a client would like to do a reverse exchange where they need to acquire property before they can sell property.
Teresa, a couple quick questions just for clarification. So is a investor required to use a qualified intermediary, and what makes a company qualified to be an intermediary?
It's a very good question.
Yes.
Using a QI is absolutely not required, but the regulations that were issued in 1991 provide specific safe harbors for taxpayers to avail themselves of. And one of them is to use a qualified intermediary, which means if you hire a QI to help you and your transaction is audited, it won't be as closely scrutinized if you've structured it to fall within the safe harbor. So I would say most exchanges probably do involve a QI. The qualifications for being a QI are that, obviously you have to be extraordinarily good looking and quick on your feet, right?
That's right.
Honestly, Teresa, you want to answer that one? There's
Well,
really
yes,
no
and it's,
technical requirements.
thank you, Mary. The one thing about the 1031 exchange industry is that it's a very low regulated. Very few, guidelines that we follow under the safe harbors for the IRS regulations. And one of them is how the client's funds are held in a 1031 exchange account. So the safe harbors say the use of a trust account or the use of an escrow account, which basically means there are QIs that are out there that can commingle funds. They can tap into those funds for their own personal use. And we have seen a lot of QIs that have gone bankrupt. They've had some Ponzi schemes. We saw a lot of things happen in 2008, 2009. So we always let clients know, you got to do some due diligence. You don't want to just take somebody's word when, your money is going to be placed somewhere. You want to make sure your money's going to be there. You want to make sure it's going to be there when you acquire purchase property. So what we've done at Chicago Deferred Exchange for 30 years is we've gone above and beyond what the IRS requires. And we create a separate trust for every client, every transaction. So if it's 100,000 or 100 million or $1 billion, that money is held in its own separate trust in the client's name, which provides protection from bankruptcy. So it doesn't sit on our balance sheet. It doesn't sit on the balance sheet at the bank. So if something were to happen to us or the bank, the client's money is isolated and protected. So, most everyday taxpayers, they may only do one or two exchanges in their lifetime. A lot of our clients haven't done an exchange before, so they don't know what they don't know, right? So they don't know what to ask, and they don't even know that they don't know what to ask. So, we do a lot of education with our clients, with crossing the T's and dotting the I's, and, make sure that they understand that there are differences and their money is safe.
Awesome. Thank you for the explanation on that.
Sure. So some of the benefits of doing a 1031 exchange, the main benefit, what we see is, estate planning and tax deferral. So clients have to decide at some point when they're getting ready to sell investment property, are they going to do a 1031 exchange, or are they going to pay the tax? So tax deferral, this is kind of what the rates look like: 20% for federal, 25% for federal depreciation recapture tax. In the state of California, we have 13.8, and then there's the 3.8 Medicare tax on the net investment income. So diversification of their real estate portfolio, maybe, they want to sell a few smaller properties and go into one larger property. They want to sell a larger property and go into a couple smaller properties. They want to consolidate, maybe they're looking for increased cash flow as they're going towards retirement. They may want increased appreciation, pride of ownership, owner user, better location. So there's all different reasons why people exchange. And then if they set up everything with their trust and their estate planning, then hopefully, their heirs get that stepped up in the basis, upon the passing of the actual taxpayer. But there's all different reasons. And what, Mary and I and everybody in our company finds is that, everybody has unique, very specific reasons to why they're selling and, what their plan is, kind of what their journey is through investing in real estate.
And it seems like it really boils down to a strategy, right? So you want to have some sort of a strategy. And if you have more funds, capital that you're able to work with and continue to defer that, you're able to grow more, diversify more, right?
Absolutely
Yes.
correct. Also, I think I would like to say that you don't want the tax tail wagging the business dog, right? So the primary driver is, of course, the tax deferral component of the transaction. But as Teresa said, every investor has different objectives, different ideas about whether they want to still be in a certain sector of real estate or whether they like to be in an armchair type investment or whether they'd like to trade down in value and take some cash out. It's a very individualized decision.
And so, Teresa, I know you're going to get into, this is one of the biggest questions that we always get are, what can we trade into, right? What property trades into what? And so looking forward to hearing about this.
Yes. So we have many clients who think, if they own apartments in Oakland, they can only buy apartments in Oakland, or they don't realize that they can actually exchange out of vacant land that doesn't produce any income into something that does produce income. So, you can interchange any type of real property as long as it's held for investment anywhere in the US. So you can go from multifamily apartments, duplexes, fourplexes, single family rentals, condos, shopping centers, strip centers, vacant land, industrial, warehouse, office, retail, ag, timberland, existing leasehold interest with 30 years or more remaining. You cannot exchange into a brand new lease. Easement, single tenant, triple net leased properties, your CVS's, Walgreens, McDonald's, Jack in the Box, dollar stores. Beneficial interest in a DST are very popular, the Delaware Statutory Trust. So they do qualify as like-kind property. And basically, there are providers out there that provide a Delaware statutory trust where you purchase a tenancy and common interest in a larger piece of real estate with other people. So they have different values and different equity amounts that you can put in there kind of based on what you need your slice of pie to be for your 1031 exchange. And then tenancy in common, so you could buy something larger, with other people, but one of the key things that we'll talk about later is, how you have to take legal title to your properties in an exchange.
So Teresa, this looks like a pretty exhaustive list here. I mean, it seems like it covers pretty much anything. Is there something common that investors come to you and say, I want to transfer into this, and they cannot? Something that's not on this list that's not allowed that you do hear people saying they want to trade into?
Yes.
Yeah.
I think it's people wanting to buy interest in a partnership. So say someone is selling multifamily property and they come to us and say, hey, I want to invest my money in this LLC that owns an industrial warehouse. And the issue with that is that what they're doing is they're using their money in that case to buy an interest in an entity and not the underlying real estate. And that's one of the most common questions that we get.
Makes sense.
People are raising money to purchase property, a fund, and, they're looking for investors' money, but they're not actually selling any real estate. That's another kind of common, they're forming something to purchase, but it's a different type of investment. And then second homes as well. A lot of times there's confusion around a vacation home, non-owner occupied, and second homes. And we kind of have that in our common issues to talk about with people. It has to be acquired with the intent of holding it for investment purposes for some period of time.
Okay.
This is an example, kind of going back to a client having to make a decision on if they want to pay capital gains tax or they want to do a 1031 exchange. So as we mentioned, we need to be involved prior to the close of escrow. And this is kind of just an example that we can run to. So there's a purchase price of $1 million. They had $100,000 worth of depreciation, which was deducted, capital improvements of $50,000, and then today they're selling for $2 million. So basically they purchased for $1 million, they're selling for $2 million. It kind of gives their adjusted basis in this example, $950,000. So what's this going to look like if they don't do a 1031 exchange? So you have your sales price today less the adjusted basis of $950,000, which gives you a realized gain of $1,050,000. So we have the depreciation recapture tax at 25%, which is $25,000. Federal capital gains tax at 20%, which is $210,000. California, if you're selling in the state of California, the 13.3, which is $139,650. And then you have your net investment income on the Affordable Health Care Act, which is the 3.8% at $30,400. So your total approximate tax bill would be $402,000. And you're like, wait a minute, I bought for $1 million, I'm selling for $2 million. You mean I got to pay $400,000 in tax? So you can see how that number will increase based on, you know, how much you paid for your property and how much you're selling it for today. So, and a lot of people are happy paying the tax. You know, they've had really good investments and they decide, you know, I'm 75 years old, I'm fine to pay the tax. Other people, they don't want to pay $10,000 worth of tax. It doesn't matter how small that number is, they don't want to pay the tax.
Yeah.
So it just gives you an idea of what, and we, in our role as the qualified intermediary, you know, we hold clients' hands, we walk them through the process, we let them know of any potential red flags and what will or will not qualify. So we can, you know, within, you know, 20 minutes of talking with the client, you know, we know if they've got a good, clean transaction or if there's some potential red flags. You know, we cannot provide specific tax or legal advice to our clients. So we always say, talk to your CPA. They can give you an Excel spreadsheet to kind of give you an idea of what your, you know, what's your tax going to look like, because, you know, you've either exchanged into that property, so you may be carrying something forward, you may have some losses that can offset some of the gain. And, you know, at the end of the day, you want to make sure that it makes sense for you to do a 1031 exchange. You don't want to just kind of, you know, run into this transaction and, you know, try to find property that may not work for you. But it's good to do some, you know, serious thinking around if it makes sense, and, you know, you have plenty of time to do due diligence.
So Teresa, that's a great point, because I think that any type of investment strategy, especially revolving around real estate, you need to kind of look at your big picture financial strategy, right? Which includes talking with your CPA, your financial planners, wealth managers, whoever is really that inner circle. Should people be talking to these folks before they contact you to get kind of an idea of what the scenario would look like, and then come to you and say, we've done our research, we know that this is the route we're going to go, let's get the process started?
Well, we're happy to talk to clients at any time. I mean, when they're thinking about selling and they may have some questions about the process or how it works, you know, we're going to let them know they need to go back and talk to their CPA and, you know, so they get an idea of what this is going to look like for them. You know, but there's not a specific time. You know, we just have to be involved before they close escrow if they want to do an exchange. So we have people that let us know a year in advance, 2 months in advance, 2 days in advance. You know, we're experiencing
Right.
some of that the last couple
Sometimes
days.
2
That
hours
never
in
happens,
advance,
does it?
Teresa.
Yes, yeah,
Yeah.
I got somebody right now that's trying to close tomorrow, so I'm like, yeah.
Wow.
We make it happen. We definitely do. We pull it all together. You know, our team's been working together for 20 to 30 years. I mean, this is what we do all day long.
Yeah.
So this
Making
is our
miracles
wheelhouse,
happen at the
our
last
lane.
minute.
It's all we do.
Yeah.
Yeah. So
That's great.
Hey,
So
Scott,
I know
I would
you're-
add that, oh, I'm sorry.
Go ahead.
Go ahead. I was going to say, I would just add that in addition to that, it's important for an investor to always know what their cost basis is in the property, so that they can make sure if they decide to go down the road with the 1031 exchange, and maybe they do want to take some cash out, they want to make sure that they're buying enough replacement property to get some benefit from the exchange. And if their basis is relatively high, that may not be the case. So always important to know from your CPA or your accountant what your adjusted cost basis is in your property.
Great point. Okay.
well, they want to make sure that they're going to benefit by doing the exchange, is, you know, because if somebody bought that property for $1 million and they're selling for $2 million, and maybe they want to do a partial exchange, you know, and they only want to buy property for $500,000, you know, they're really not going to benefit till they get at least up to the $1 million, you know, at least to what they paid for it, you know. So it's like you kind of, you know, so you have to, that's why you're crossing T's and dotting the I's. And if they tell us what they're planning on doing, then we can say, you know, here's what the requirements are. And when we get into these boot slides, you know, some really good examples as far as what we see and what the requirements are if somebody does want to defer 100% of the tax. So boot or other property or money received in the exchange that is not like kind to the property given up and causes gain recognition. So boot netting rules, basically there are two requirements if you want to defer 100% of the capital gains tax. So you want to acquire a replacement property that's going to be equal to or greater than the sales price of the property that you're selling today. So if you're selling for $100 You know, that's the amount that you would need to acquire equal or greater than, not necessarily what you paid for it or what your net equity is on it. And then the second rule is all of the cash that comes into the exchange needs to go into the new property. So we'll talk a little bit more in depth about these with the slides that we have.
I cover these?
Yeah, do you want to go ahead?
Sure. Yeah, so this slide shows us, we're just going to have some very simple examples here. We have our taxpayer who's selling property for $100. We're assuming the property is not mortgaged, and we're just going to ignore selling expenses for purposes of these examples, just for ease of computation. So we sell for 100, we get equity out of the transaction of 100, and then we find replacement property with a fair market value of 100, and we spend all of our equity. The cash that we pay for that replacement property offsets the cash that we would have otherwise received from our sale. And we've met our two rules. We bought property of equal value and we've spent all of our equity. So there's no boot in this transaction. In this example, we are assuming that our relinquished property is encumbered by a mortgage of 50. When we are relieved of that liability, of that mortgage, that could cause us to have to recognize some gain if we don't offset that debt with either cash or new debt when we go to buy our replacement property. So
that's a very common question.
Yeah. Sorry. Do you want to finish? In this example, we are sorry.
You want me to go back?
Yeah. Okay. In this example, so we're relieved of that liability of 50, and we're buying property for 100, equal value property. We're putting fresh cash into our acquisition, cash of our own. We're just not leveraging this property up. So again, we've met our two rules. We bought property of equal value, and we've spent all of our equity on replacement property. That new cash we put in offsets the debt relief from our disposition. The next one, we're just matching up the debt and equity on both sides of the transaction. So we're selling for 100, we have debt relief of 50, we have equity of 50. We buy property of equal value for 100. We get a new mortgage we put on that property for 50, and we spend all of our equity to close out the transaction. So there's no boot here either. That new debt offsets the debt relief. In this one, we have a little bit more debt than we need relative to the amount of cash that we have to spend on our replacement property, and we are going to have some boot in the transaction. So we're selling for 100, debt relief of 50, equity of 50. Our lender on our replacement property wants to give us a 70% LTV. So we have a new mortgage on that property for 70. The net result is we're only spending $30 of our equity. $20 is going to be cash boot to us if we don't otherwise buy other replacement property, or possibly adjust our loan prior to closing so that we only take as big of a mortgage as we need to make the acquisition work.
This is, you know, something that I think happens a lot when people aren't talking with their advisors. You know, they're happy to get more money on the loan. And it's one thing if they're leveraging up and they are buying property of more value, because you could certainly sell for 100 and buy for 500, and, you know, you would get additional financing. But the key here is that you don't want to overfund your loan and walk away with any cash, because if you walk away with cash, you're going to have taxable boot. And, you know, clients that are selling investment property, I mean, they're usually business owners. They're professionals like all of us, you know, and they're trying to manage, you know, families and working, and then looking at their investments, and they're talking with the broker and selling property, buying property, looking at property, talking with their lender, talking with their attorney, talking with their CPA. And then we come into the mix as the exchange intermediary. So there's a lot of, you know, balls moving. And I tell clients, you know, when they say, what are you not telling me? I said, well, you really need to be engaged, because you have to be able to make decisions within certain timelines. And, you know, and so, you know, that's kind of how that's how I try to get people in the right, you know, frame of mind when they're going to do an exchange, is you really have to be engaged, because there's timelines,
lots of details,
decisions. Yeah.
So here's the question on that last slide. Let's say we adjusted our loan so that we were only taking 50, so we spent all of our equity, and the investor now wants to refinance the property and take some cash out. There is some concern around having that refinance happen the same day or even shortly after the purchase of the replacement property. We typically recommend that people put a little bit of distance between that purchase and the refinance and the pulling of the cash out. What are your thoughts, Teresa?
Well, you know, we have two different, you know, there's two different two different thoughts. You know, some people will do it a day after, other people may wait 30 days. Sometimes I think they have so much going on that they're just happy the transaction is done. But there's, you know, not a real exact answer on how long you should wait before you refinance your purchase property or take some cash out.
So I've got a question real quick that ties into this. So, and I imagine you guys probably hear this. Somebody says, I have X amount of dollars, you know, that I'm going to net from the, or take from the sale of the property that I need to reinvest, but I want to be able to pay off some debt, right? So I want to pull some boot, we'll call it boot, right? So pull some money aside. My light went out here. So pull some money aside and be able to, you know, allocate that to something else that's not going to go into it. How do you respond to something like that?
Well, we take a look at their closing statements, right? And we let clients know, I mean, if you're trying to pay off somebody, you know, like sometimes people give people a loan and then they don't record it on the property. So then it's going to look like, you know, you're trying to pay back, you know, Scott, you know, $50,000 that, you know, he gave me to buy this property. And when I sell the property, I want to pay Scott back the $50,000 that he lent me. But if it's not recorded on the property, you know, it has nothing to do with the exchange. So therefore, you know, that's considered taxable boot because I'm giving cash to somebody that's, you know, not part of the transaction per se. So,
but you can you can also intentionally have boot. So let's say you did want to just pull some cash out for whatever purpose.
mm-hmm.
As long as we know that up front, that's absolutely acceptable. And as long as the investor, taxpayer understands there's going to be, you know, implications from that, there's no problem with them doing that at all.
Okay. So a portion is going to be taxable, portion is taxable, and a portion they know is not going to be taxable, but they're planning that ahead of time.
Right.
Yeah.
Okay.
So there's some things that come into the gray area with that, because when you see a settlement statement, a client may not think it's going to be taxable boot, you know, if they're paying off credit card debt or something, and then, you know, they'll get a phone call and say, you know, this might be considered taxable boot to you because it's not something that's relating to the exchange. So, you know, those types of things come up. So one of the other requirements of the 1031 exchange is that the IRS wants to see the same tax reporting entity that's selling be the same tax reporting entity that's buying. So in this example here, we have ABC LLC, which has owned the property for many years, filing a K-1 partnership, and they want to do a 1031 exchange, but only two of the parties want to exchange and one of them wants to cash out. So we talk about doing what is called a drop and swap. So one of the things that we go back to that's a gray area, and there's a lot of black and white as well, but you know, the gray area is how long do I have to hold investment property before I can sell it or before I can move into it. So you want to establish a middle road. Most tax practitioners will recommend a year, you know, going over 2 tax years. 2 years we know is good. You do have a 2-year holding period when you're exchanging with related parties, your parents, your siblings, your children. You know, there are very specific related party rulings, but in general, you know, if somebody wants to dissolve an entity and so 2 people can exchange and 1 person can cash out, what that's done is it gives you tenancy and common interest. So if Mary, Scott, and I own this property for many years and ABC LLC, and Scott wants to cash out and Mary and I want to exchange, and we do what's called a dropout. Now we've only held this property for how long before we're going to sell it? Are we going to do this a year in advance? Are we going to do it in the previous tax year? Or are we going to do it tomorrow because we're closing next month? And so this is probably one of the biggest issues that we see with 1031 that comes up is, you know, the gray area around doing a drop and swap in front of doing a 1031 exchange, because you haven't held the property for, you know, a year going over 2 tax years. It doesn't mean you can't do it, you know, it just, you know, it's just something to be aware of when you're thinking about selling, thinking about how you hold legal title to the property and what you are intending to do when you buy replacement property. There's also a swap and drop. So if you can keep your entity together and Scott, Mary, and I decide, okay, well, we're going to sell property, we're going to buy property together. And then after we buy property, then we can dissolve our partnership and go our separate ways then, or maybe we buy separate, you know, properties for one another. And then there's, you know.
You know what, I have a situation like this going on right now where it's a two-person partnership and they've sold the relinquished property, and their plan is to buy multiple properties part of the year, and then next year they're going to terminate their partnership and split up the properties among the two partners. So it's not often that we actually know the specifics about this kind of swap and drop, because the drop typically happens after our involvement has concluded in the transaction, but it's a really good solution if you do have partners who can stand to be together long enough, to buy suitable replacement properties and then distribute them out in the next tax year.
I don't have a whole lot of slides in here. Mary and I probably have like 85 slides, and we kind of condensed it down, but one of the things I noticed we didn't talk about was, we talked about our involvement, getting involved prior to the close of escrow. So, we draft documents, the funds come in at the close of escrow. The next day is what starts the official timeline for the 1031 exchange. So you have a total of 180 calendar days to purchase the new property, but you have to identify the property within the first 45 calendar days. So there's, every single day counts, weekends, holidays. So that 45-day window can go a little bit quickly when you're trying to find property. So we always, let clients know if you're thinking about selling, you should also be thinking about your purchase, so your sale or purchase. And, you have general property rules that you have to follow. You can identify up to 3 properties anywhere in the U.S. And you can revoke and change your mind as much as you want during the 45 days. If you decide that you don't want to do the exchange, or, it's not going to work out, or you don't identify anything, then we would return your funds on day 46, and you would be subject to the normal tax that you would have paid had you not done an exchange. So there's no additional penalties for trying to do an exchange. And if it doesn't work out, it's just, you kind of have to know that your money's going to be locked up for the first 45 days of that identification window. And then ideally, you're able to close on your purchase property that you identified within the 180 days, and you have a valid exchange for a forward exchange.
Teresa, I want to talk about the 180-day rule a little bit, because there's a little bit of a nuance there, because here's what the code actually says is you have to acquire replacement property 180 days from the date that the relinquished property is transferred, or the due date of the taxpayer's income tax return for the taxable year of the exchange, determined with regard to extensions, whichever is earlier. Whichever is earlier. What does that mean? At this time of year, it's important to know what that nuance is. What it says really basically is if you sell property on or after about October 17th or 18th in a given tax year, and you are a calendar year filer, so your return would normally be due on April 15th. After October 17th, day 180 falls after April 15th. So you want to make sure if you have exchanges that you're entering into toward the end of a tax year, you're extending your filing deadline. If you don't, your exchange period will end on the due date of your return filing date, April 15th. So it's a footfall that people sometimes miss, and it's a nuance that's important at this time of the year.
Absolutely, because there's no extension of the 45 days or the 180 days. Sometimes we do get minor extensions that, the IRS will issue. There was one initially a little bit about COVID and, with some of the fire, but it's a pretty specific ruling comes out, in regards to those timelines for clients that are in an exchange. So you can't just randomly think that you're going to get an extension. It has to be issued
by the IRS.
But, from the IRS.
We did get a little bit of, sorry, we did get a little bit.
Go ahead.
Yeah. So we were sort of, petitioning the IRS and Treasury to give a little bit more relief for 1031, investors relative to the pandemic. As Teresa mentioned, they did give us a little bit of guidance, a little bit of a respite. Back in April, they allowed investors to extend either day 45 or day 180 from April 1st to July 14th. So that relief is now gone. It's over. It's no longer applicable. But as Teresa mentioned, when there's a federally declared disaster, like the wildfires, like the hurricanes occasionally, typically the IRS will issue guidance that does allow taxpayers engaged in like-kind exchanges to extend their deadlines, both of their deadlines, by 120 days. So the wildfires are a great example. If you're doing an exchange right now and you're an affected taxpayer, you may be able to extend your time periods.
Mm-hmm.
Sorry,
And
back
here's
to you.
just common issues that we can talk about. You know, we talked a little bit about partnership, drop and swap. You know, IRS wants to see the same entity that's selling be the same entity that's buying. Held for investment requirement for some period of time. You know, people have questions around doing construction or improvements. They want to use exchange proceeds to do improvements, related party transaction, vacation home, personal use property, split treatment. You know, maybe they have a fourplex and they live in one of the units. So one of the units is, you know, 25% of it is primary, 75% of it is investment. So you can certainly do that. Seller financing. A lot of times people want to do a seller carryback note for their buyer who may be having an issue with financing. Closing costs, lender fees, earnest money deposits. So these are, you know, there's a whole wide array of things that come up with 1031 that we can talk about, or if you have other questions for us, Scott, we can answer. Anything you'd like to have us go into more detail on?
I've got a quick question on the split treatment, because this has come up a couple of times. Let's say you own a duplex or a fourplex, you occupy one of those units, the other ones are rented out. What does that look like, you know, from a 1031 exchange perspective?
Sure. Well, I think it really comes down to how they're reporting it on their tax return. So if I own a fourplex, you know, I'm going to be telling my CPA, okay, you know, they may do it based on square footage. You know, maybe I have the larger unit, so it maybe that's 30% of the property. And then when I do an exchange, 75 or 70% of it's investment, 30 of it's a primary, you know, it could be just 25 and 75. But it's all how they're reporting it on their tax return. So they want to be very clear that, you know, not all of the units are, you know, I mean, what percentage is investment and what percentage is their primary residence. So then when they sell, they can do both, buy another primary residence and then buy investment property that's going to be equal or greater than that percentage portion of that sale.
Okay, so they're allocating a percentage and a value to it, and then that is going to be the piece that's going to exchange into something else. Is that right?
Mm-hmm.
That's exactly right. Yes.
Mm-hmm.
Yeah.
We do get some questions lately, and I don't know if it's just, you know, people have a little bit more time to strategize, but, you know, there is cases out there, you know, where it doesn't say how long you have to hold property before you can move into it. So sometimes we've had people that have property for investment and then they decide to move into it, you know, and then maybe they turn it back around and be investment. So there's a 5 out of 5 year holding period when you convert, you know, either primary to investment, investment to primary. So, you know, again, the CPA really has to take a look at, you know, how are they reporting it and how are they using that property, you know, for what percentage of it would qualify for 1031 and what percentage of it would be for primary.
Also, just generally, how long do I have to hold property before I can exchange it for other like-kind property? That's a very common question that we get, and there's case law that is all over the board on how you determine whether property was held for investment. But basically it comes down to facts and circumstances. We want to make sure that if you're doing these, if your clients are doing these, that it's clear from their actions that their intention is to hold primarily for investment and not primarily for sale or primarily for personal use purposes. What do we look at? Sometimes there's an old private letter ruling from 1984 that says 2 years of business or investment use is sufficient to meet the requirement that the property was held for investment. We certainly see investors take more aggressive approaches than that. But generally, I would say the transactions that we're working on, taxpayers have held on to their properties for some period of time. How about seller financing, Teresa? That's kind of a tricky one. And it's coming up more frequently too, because lenders are getting a little bit more skittish, I think.
Yep.
Buyers are looking to sellers to help them finance acquisitions now.
So a seller carryback, when a seller calls us and say they want to do a 1031 exchange, and they, you know, we talk a little bit about, you know, what they're selling the property for and, you know, that they need to buy equal or greater and use all their cash from the exchange, you know, and they say, I am going to do a seller carryback note for the buyer. And so when you think about when they actually close escrow, you know, there's the cash that comes in, but now they have this note that's a piece of paper, you know, it's cash and paper. So they have to decide, you know, what it is they're going to do with the piece of paper. So sometimes the note can have a very short period of time. You know, maybe it's a 30-day note or maybe it's a 90-day note. It might be a 5-year note. So now the taxpayer, I think a lot of times what we see is, you know, the taxpayer can replace that note or cash, that's ideal. If they can't, they can still have the note come into the exchange, and then, those payments can be deferred while the note is sitting in the exchange. But the challenge is, what are they going to do when they go acquire purchase property? Because the seller of the property they want to buy, they're not going to, more than likely, not want the terms of this note. They're like, no, we want all cash, or, financing to buy our property. So then, they have to be faced with having the note come out of the exchange and having some sort of, taxable gain as those payments come in. And then if they do get a larger balloon payment, they can't do an exchange at that point with a larger sum. They have to do the exchange when they actually sell the property. But we do see quite a few, it's a very common question that comes up.
But if they're able to monetize that note, as you said, replace it with cash prior to buying replacement.
Mm-hmm.
That's ideal. Closing costs and lender fees. So we sort of ignored selling expenses a little while ago when we were talking about boot, but certainly any expense on a settlement statement that typically occurs under local custom as a seller's obligation can be used to reduce cash boot in the exchange, like your broker's commission, transfer taxes, title insurance fees. Generally, attorney's fees, are those typically on settlement statements in California?
We do fees, and what we want clients, if an attorney submits an invoice to be paid at the close of escrow, it really should be based on the work that they did for that particular transaction, not a year's worth of attorney fees if they were, doing all these other things. So I think you got to be mindful of if the fees that are being paid on the settlement statement pertain to this actual sale of that property.
And then lender fees are tricky.
Yes.
Talk about those. You're good at that.
Lender fees are hard. Ruling out there from 1972 that we still, rely upon today, that, can deduct, as Mary said, the broker commissions, transactional costs like your title, escrow, transfer tax, recording fees. But the new lender fees, you cannot use exchange proceeds to acquire and pay for lender fees for a new loan. And, that question comes up quite a bit. It's pretty clear that you can't do that. It's just one of those things where I think the IRS, you could actually acquire all that property with cash. You don't, it's not required for you to have new lender fees as part of your exchange.
Right.
Is that how you would say that, Mary? Or
yeah, I mean, I think it's considered to be a cost of the financing and not a cost of the property per se, which is kind of silly, but
it is.
Nevertheless, that's out there. And then earnest money deposits. What's the issue there?
Well, earnest money deposits, we can have a non-refundable deposit come into the exchange. If we have exchange proceeds, we can make earnest money deposits on behalf of the seller. If the seller, has not closed on their relinquished property yet, and we have no proceeds, and they need to make an earnest money deposit on a purchase property, they can make the earnest money deposit cash out of pocket. And then once they close escrow on that purchase property, they can receive that deposit back through escrow. So we're not actually reimbursing them. The exchange proceeds would reimburse them, at the close of escrow when they acquire that property. So if we have clients that are holding earnest money deposits, and they haven't closed escrow yet, I mean, that's technically taxable boot to them right now. And I've got 2 clients right now that have quite a bit of earnest money deposits. And they're like, well, yeah, but we're not closing till December. It's like, so they've got this money that's out there that's looked at as taxable. So there's always that question of, well, talk to your attorney. Can you put it back in escrow before you close? It's those types of things that kind of come up, and maybe they're fine paying taxable boot on it, but we're very upfront about, well, if you keep the deposits out of escrow, it's going to be taxable boot to you once you figure out getting it back.
And we think that once it's boot, it can't be undone, right? So if your taxpayer seller takes the deposit directly from their buyer and plans to put it into the closing escrow before the closing occurs,
yeah, I think there's just like with the, there's different schools of thought on different things when it comes to 1031. It's like, that's what we run into. And some people are fine with that. And other people are like, no, and they'll challenge it and believe it. And this is going to be how it's going to be. And, we don't provide the specific tax or legal advice. So if, that's where it gets a little, it gets a little muddy waters here with some of these common issues, because there's kind of like, here's what it is, but there's a lot of black and white and a lot of gray area, and the gray area comes down to risk tolerance, of our clients, and of their advisors, and with the industry being unregulated, you have 45 calendar days to identify property. Well, in our industry, we have people that will ignore the 45 days and go, we'll just do a little paper shuffle because, everybody knows you need more than 45 days. Well, we don't conduct our business that way. That's not what the IRS regulations rule, what the rules say. The rules say you have to identify property within 45 days. So that's what you need to do. And you need to identify property to us as your qualified intermediary. So we don't do any of that game playing. We make sure we protect our clients and we protect our business, and we do what's required under the IRS regulations for Section 1031. So the industry for sure.
Every deal is different. Yeah, I mean it's fun, and every transaction is different, and I think things have evolved so much. I learn something new almost every day. Keeps it interesting.
It is. Well, yeah, especially with the reverses and the improvements. It's like if people are like, I'm not ready to sell my property yet, but I just found the property I want to buy. Can I buy it first? And it's like, so we do a number of reverse exchanges. And, with the reverse, because you're acquiring the property first, you haven't sold your existing property. So you have to come up with all the cash up front or lender financing. So, we get involved as the exchange accommodation title holder prior to that close of escrow. And then we actually take legal title to the purchase property, and we park the property in the exchange. It has to be set up in an LLC. There's a lease agreement. You still have 180 days to sell your existing property, which is relatively easy because you know what that is. But, it is an alternative for people when they aren't quite ready to sell their existing property, especially for owner users, that have a business and they want to go to a larger or, different type of facility. They can move their business while they get their existing building up and ready to sell. So it's definitely interesting. Every client's different for sure.
Teresa, we've got a question. We're talking about kind of the 45 days to identify. How many properties can you identify?
Well, you can identify up to 3, which is the most common. So you can identify up to 3, any fair market value, but the IRS does put a cap on it that if you want more than 3, you cannot exceed 2 times the value of what you sold. So basically the IRS doesn't want somebody to go out and identify 50 properties or 100 properties so they know they'll have something they can close on. They're like 3 any value. If you want 4, you can't go over 2 times the sales price. So, we see people identify, on both of those quite often.
Yeah.
So if you sold for $1 million, you could identify 3 separate properties at $1 million each. But if you sold for $1 million and wanted 4 properties at $1 million each, that put you at $4 million, which is more than double the $1 million at $2 million. So, it's kind of one or the other.
So, Teresa,
yes.
This is great. And I want to remind people, if anybody has any questions, go ahead and put them into the chat box here. And so we talked about the common issues. I think we talked about most everything. Was there anything else that you guys wanted to mention?
Yeah, I can talk a little bit about the threats to 1031 again, which may be coming down the pike. As I mentioned back in 2017, 1031 took a haircut in that it was modified so that you can only now exchange real property and no longer any kind of capital assets or personal property. The Biden campaign has put out a proposed tax plan which would eliminate Section 1031. I would say back in 15, 16, 17, when the Republicans controlled everything in Washington, they were of the same mindset. They wanted to repeal 1031. And we spent a lot of time, as I mentioned, on the Hill talking about what a great economic stimulator 1031 is, what a great wealth builder it is for people, right? It's like, oftentimes people will only do a single exchange in their lives, and it's just a great way to accumulate wealth. So we had to educate a lot of people in DC, and now that the Biden campaign has come out with a similar proposal to repeal 1031, and there may be a Democratic sweep in the coming weeks, we may be back on the chopping block. So I would say keep your eyes open for that. We have a website that our trade association has put up called 1031taxreform.com that has lots of information that you can read about it and send a letter to your legislator, congressperson, or senator expressing your support for 1031.
And are you seeing investors with this potentially happening? Are you seeing investors run for the gates and just say, I've got to do something quickly?
A little bit of both. I mean, there's also the specter of the capital gains rate being raised, right? If there's a Biden administration and a Democratic-controlled Congress, to like ordinary income or maybe even 36%. So we've heard a little bit of both. Some investors are thinking, I'm going to sell now and just pay the cap gains rate at 20% because it's going to be 36% next year. Some are, yes, trying to get changes done in the event that they do go away. I would expect that if there is legislation, tax legislation that comes out, January, February, it's my guess and my hope is that they would not eliminate 1031 because that would really kneecap real estate, right?
Yeah, absolutely.
It would also affect would much longer, and with this recession and the pandemic, and it's the last thing they really want to do is hurt real estate.
Okay. Well, that's good. I wasn't aware of all that, so I'm glad that you mentioned that, and hopefully it brings some awareness to other people of what potentially is coming, on the pipe. Teresa, do you want to give? Do you have a slide that has your contact information on here, just in case if people have questions?
I think it's our first slide. It has both Mary's direct and my phone number. Our website, cdic1031.com. If you like, I could send you our one pager that you can distribute to the attendees if you like.
That would be great.
Like just
yeah.
the bullet points on a forward exchange and reverse exchange with our contact information. And we all work as a team. So whoever you call, that's just how we operate.
Perfect. Okay. I know that my internet connection is getting a little unstable, so hopefully you guys can hear me okay. But any questions that anybody has, any of our viewers, whether it's for myself or Teresa or Mary, feel free to send it over. You can send it to info@leavingthebayarea.com. Terry's asking, can we get a copy of this entire presentation? Yes, within a few days, I'll have this recorded and we'll have a copy that we can send out to you. So again, just send an email to info@leavingthebayarea.com and we can get you a copy of this recording. So that's great. All right, well, Teresa, Mary, thank you both so much. This has been fantastic. Great information from you both. And wish you continued success, and we'll certainly stay in touch and appreciate you being available for people who are looking to do the 1031 exchange.
Thanks for having us, Scott.
Yes, thank you, Scott.
Take care.
Okay, you're welcome. Bye, everybody. Take care.
Bye.